I mean, first of all, I heard all the comments all the other guests made, and I agree. This is a pretty treacherous period for markets. But I'm still going to lean into this weakness. And the reason we think it makes sense to is, one, I think the jobs report is validating that the underlying economy still remains pretty strong. And with the move in rates, and while that's alarming, we still have negative real interest rates. And then we know investors have essentially panicked because they raised a lot of cash in the first 8 weeks of this year. And on top of that, sentiment has collapsed. And I think, a seismic hit like Facebook even added to that misery. So the cues I'm sort of looking at, and the reason we're staying bullish is, the VIX term structure is actually normalizing, which means it's a risk-on signal. And I'm kind of encouraged by the rally in oil because that is a sign of underlying health of the economy. And I think on a risk-on, one of the cues that we should be focusing on is the fact that Bitcoin's back above 40,000. So we're still going to tilt towards February. It's going to end up being a rally month, but clearly the last couple of days have been, horrifying.
What happens if the 10-year goes over 2%, Tom Lee? Is the market able to have a violent rally in the face of a 2% 10-year? Now we are, 30-some-odd% predicting a 50 basis point move, or at least another hike. I can't remember where we are, at least at this point. But the fact of the matter is the market's expecting a more aggressive Fed this morning than it was yesterday. 2% 10-year doesn't throw you off?
I mean, it is about perspective because, for someone who started to track rates, in 2020 at 50 basis points for the 10-year, it's obviously alarming. But, in 2019, the 10-year was over 2%, and it was nearly 3%, or actually almost 3.5% in 2018. So I think a 2% 10-year, and if CPI is 3, we still have negative real rates. That really generates excess returns for risk assets, for assets deployed for real estate. So I view it as a risk-on signal still.
So Bank of America is out with some commentary. I'd like to get your reaction to it, if I could, Tom. They talk about, quote, an inflation shock, second half of 21, which we witnessed, the rate shock in the first half of 22, and a growth shock in the second half of this year equals negative returns in both credit and stocks. You want to take issue with that?
I mean, I agree with that these are shocks, meaning inflections. Growth, U.S. real growth is still going to be positive, but it can't match the numbers that we saw in 2021. But, do stocks need 5, 6, 7% GDP growth to actually still go up? They don't. They need nominal growth. And nominal GDP growth still be 7%. And if we have the 10-year, even though it's been a rate shock at 2%, that's still a 50 PE for a government bond, and you're still paying nearly 25 times to buy a high-yield bond. So can the S&P PE hold at 20? I think so. And, I think there's still innovation that's being generated by this pandemic, because even though people talk about how great this employment report is, there's still 2 million less people working today than there was at the end of 2019. But productivity has allowed total output to actually exceed that. I think that's pretty impressive. So that's operating leverage. So I think this would still be a great environment for stocks. And again, there's 142 trillion of assets held by households, of which like 60% are in bonds. We have to remember, households have to decide how much credit they want to own if the 10-year yields are going to go up, because they're guaranteed to lose money owning any kind of bond. And so guaranteeing TINA, I just think means it flows into equities, into risk assets, real estate, and even crypto.
Well, you've been continuing to recommend, when it comes to equities, the FANGs, right? And after you picked your jaw up off the floor from Facebook's print, I'm wondering what you think of the fragility of that trade, whether you think it's still intact. Now, obviously, Facebook doesn't tell the whole story because there are other FANG components, Amazon included today, which knocked the cover off the ball, and Apple, Google, and some of the others did as well. Microsoft is the one I'm trying to think of. You worried about that trade? at all, Tom? I mean, you're not getting a massive follow through today in NASDAQ like you got a drift lower or an elevator down lower in Meta.
Yeah, it's a great point, Scott. I mean, foremost, if someone said, hey, look, investors are so bullish, that they're buying anything, the Facebook sell-off just shows you the market is nervous and has a hair trigger. So to me, I think it's really a confirmation that conviction in this market is not that strong, which I just don't see as a sign of a top. I think at the top, everyone's bullish and they'd be, saying they're going to buy the Facebook dip. I don't think people are. But yes, from a market perspective, it is a huge economic blow, primarily to holders of Facebook, because, the reality is Facebook's sort of earnings miss doesn't have much implication for GDP generally, because, as you know, it's not really going to hit the ISM or the PMIs and probably not going to hit employment. So to me, it shows you that there is a company-specific issue. But would I be looking at 26% sell-offs as a buying opportunity? I mean, strangely, I'd say I think Facebook's going to be higher before the end of the year. But of course, you have to let all the sellers sell and sort of position square.
So I'm gonna let you go, but before I do, I just want to confirm that you think that we're set up for a 13% gain, presuming you're talking about the S&P 500, a 13% gain over the next 6 months, and we're going to hit new highs after we get through this treacherous period. Is that what you think?
Correct, Scott. That's right. Yeah, we published something this morning just highlighting that since 1938, if you look at the type of waterfall decline the stock market had, which is almost 11% over 14 trading days, that's actually like a 3 percentile move in markets. And over the next 6 months, the median return is around 13%. So this is just saying within the next 6 months, the S&P reattains 4850 or so. And that's our base case, yes.
All right. Tom, I appreciate hearing your point of view, and I know our viewers do as well. And I've said it 1,000 times, at least at this point, probably 10,000. You've been right. We're going to see if you remain that way. Tom Lee, thank you.